As the markets have closed for the day on Monday, October 6, 2025, we're looking at Rezolve AI PLC, trading under the ticker RZLV, which finished the last session at a price of $6.79. This represented a significant single-day gain of over 8.21%, a move that has many investors talking. But the story here isn't just a simple end-of-day rally. The expectation is that this is another AI company riding the wave of sector-wide hype, a direct beneficiary of the market's insatiable appetite for anything related to artificial intelligence. The reality, however, is far more complex and interesting, especially when you consider that the company's recent earnings report contained a detail many might have missed: a substantial revenue shortfall against analyst expectations. Yes, you heard that correctly. In its most recent quarter, Rezolve AI missed on the top line, yet the stock surged. This disconnect is the core of our analysis today, the tension between the readily accepted narrative and the nuanced truth of a company in hyper-growth mode. This isn't just another AI story, it's a case study in how forward-looking guidance and strategic positioning can completely overshadow a present-day performance hiccup. The common belief surrounding a stock like Rezolve AI is straightforward. It's a high-growth technology firm, and its value is tied to the promise of future earnings powered by its proprietary AI platform. Many who have added RZLV to their portfolios through platforms like Fidelity, Robinhood, or SoFi Invest have likely done so based on the incredible momentum seen in names like Nvidia stock, assuming a similar trajectory. The expectation is that with partners like Microsoft and Google, and a client list that includes H&M and Urban Outfitters, success is almost a foregone conclusion. But let's challenge that. The deeper reality is that Rezolve AI is making a colossal bet on its ability to execute, and the market is currently pricing it not on what it has done, but on what it has promised to do. The company recently shattered expectations by raising its 2025 annual recurring revenue, or ARR, guidance to a massive $150 million, and even more audaciously, initiating a 2026 guidance for a $500 million ARR exit rate. This is the headline that has captivated investors and sent shares soaring. It paints a picture of exponential growth and market dominance. However, the fine print reveals that converting this ARR to recognized revenue has a lag time of 7 to 9 months. This means the company is building a massive pipeline of future income, but the actual cash flow and profitability are still down the road. This is a critical distinction for anyone considering an individual brokerage account to start their own self-investing journey. The expectation is immediate success. The reality is a high-stakes waiting game. Let's dissect the recent market activity to truly understand the dynamics at play. The stock saw an absolutely massive trading volume in its last session, with over 55 million shares changing hands. This isn't just retail speculation, this is the mark of significant institutional interest, and we have concrete evidence to back this up. In recent weeks, some of the biggest names in finance, Citadel, BlackRock, and Vanguard, have been disclosed as taking new or increased positions. Institutional ownership has now crossed the 10% threshold and climbing rapidly. This is a powerful vote of confidence. These are not firms that make decisions lightly. They are looking at the same data we are, the revenue miss included, and are clearly focusing on the long-term potential. They see the incredible 95.8% gross margin, which trounced consensus estimates, and the better-than-expected adjusted EBITDA loss of $17.7 million. They are looking at the recent and critically oversubscribed $200 million financing round, which shores up the company's balance sheet and provides the capital needed to pursue its aggressive growth strategy. For those of you managing your own portfolios with Schwab Intelligent Portfolios or other investing sites, this institutional accumulation is a significant bullish indicator. It suggests that the smart money believes the company's ambitious ARR targets are not just achievable, but are the key metric to watch, overriding the short-term revenue miss. This is a classic case of Wall Street looking past the immediate quarter and focusing on the 12 to 18-month outlook. So what exactly does Rezolve AI do? At its core, the company provides an AI-powered e-commerce platform called the Brain Suite. This isn't just a simple chatbot or a recommendation engine. It's a suite of tools built on their proprietary large language model, which they call BrainPower. This suite includes Brain Commerce for advanced product discovery through text, voice, and even visual search, and Brain Checkout for a streamlined one-tap purchasing process. The company is positioning itself as the essential infrastructure for what it calls agentic commerce, where AI agents can autonomously handle searching, transacting, and personalizing the shopping experience. Their partnerships with Microsoft and Google are instrumental here, as they provide a massive distribution channel into the enterprise market. Rezolve isn't just selling a product, it's selling an ecosystem designed to reduce cart abandonment and increase conversion rates for major retailers. This business model generates revenue through a combination of recurring subscription fees and transaction-based charges. This hybrid approach offers both the stability of SaaS income and the upside potential of high transaction volumes. For anyone looking for investment help or considering online investment options, understanding this dual revenue stream is crucial. It's a model designed for scalability, and with over 100 enterprise clients already on board, the initial traction is undeniable. Now let's turn to the financial health and past performance to ground our analysis. The first half of 2025 saw revenues of $6.3 million, a staggering 426% year-over-year increase. This demonstrates the explosive growth phase the company is currently in. However, the company is not yet profitable, which is typical for a business at this stage of its life cycle. The focus is entirely on capturing market share and scaling the platform. This is a strategy that requires significant capital, hence the recent financing rounds. A key point of contention for some investors was a recent Form F-3 filing with the SEC. Many immediately feared share dilution, a common risk with growth stage companies. However, Rezolve's management was quick to clarify that this was an administrative filing to re-register existing shares for resale and did not involve the issuance of any new shares. This clarification helped stabilize the stock and demonstrated a level of transparency that is vital for building investor trust. It's these kinds of details that are critical for anyone using an Interactive Brokers or Fidelity trading platform to make informed decisions. It's not just about the top-line numbers, it's about understanding the financial mechanics and management's strategic decisions. Before making any investment, it's essential to look at the complete picture. Comment below and let me know if you believe Rezolve AI can achieve its target of a $500 million ARR exit rate in 2026. Looking ahead, the future for Rezolve AI is a landscape of immense opportunity coupled with significant risk. The primary catalyst is, without a doubt, the execution of its growth strategy. Can the company continue to sign on new enterprise clients at its current pace? Can it successfully integrate and upsell its services to existing customers? The path from a $150 million ARR to a $500 million ARR is not a straight line, and it will require perfect execution. The competitive landscape is also a factor. While Rezolve AI has its proprietary brainpower LLM, it operates in a crowded field with established players like Adobe Commerce and BigCommerce, not to mention the constant threat of new entrants in the AI space. The company's key differentiation will be its ability to demonstrate a clear return on investment for its clients, proving that its platform can genuinely drive higher sales and improve margins. The risks are equally clear. Any slowdown in client acquisition could be severely punished by the market, given how much future growth is already priced into the stock. The broader macroeconomic environment could also play a role. A slowdown in consumer spending would inevitably impact the transaction volumes flowing through Rezolve's platform. Furthermore, the company must eventually demonstrate a clear path to profitability. The current cash burn is sustainable in the short term thanks to the recent financing, but investors will eventually want to see the company turn a profit. For those utilizing tools like Fidelity Wealth Management or considering long-term holdings in their Fidelity IRAs, these are the long-term risks that must be weighed against the potential rewards. In summary, Rezolve AI presents a fascinating dichotomy. The expectation, fueled by the explosive ARR guidance and big-name partnerships, is that of a future AI titan in the e-commerce space, a stock destined for the same stratosphere as other successful tech stories. It's the kind of narrative that attracts traders on platforms like the Robinhood app looking for the next big thing. The reality is that an investment in RZLV today is a high-conviction bet on the company's management and its ability to deliver on its ambitious promises. The recent institutional buying provides a strong tailwind, suggesting that sophisticated investors are willing to overlook short-term revenue misses in favor of the larger long-term opportunity. The company's technology is clearly resonating in the marketplace, and its financial position is solid for the near future. However, the path forward is one that requires near-perfect execution and a favorable market environment. The tension between the incredible promise of its forward guidance and the present-day realities of its financial performance will be the defining feature of this stock for the foreseeable future. The story is compelling, the potential is undeniable, but the risks are just as real. This is not a stock for the faint of heart, but for those with a high tolerance for risk and a belief in the transformative power of AI in commerce. It represents one of the most intriguing opportunities in the current market.